So I woke up one morning the other day and decided it would be a good idea to check my investment portfolio. I sat down on the couch, opened up my investment app, and boom, everything was red. Well, not really red because the investment app that I use shows everything in yellow, but you get the point. The $26,000 that I've contributed has turned into just over $25,000 instead. My money's no longer growing and instead it's losing its value. But then the next day I got my tax return back and I decided to put that entire amount of money that I got into my investment portfolio and keep buying investments. Why would I do that when I just said that everything's going down? The simple answer is because when the market's down, it's a good time to buy. My portfolio being up is really only beneficial to me when it's time for me to use my investments. But if my plan is to invest for the long term and to dollar cost average into the market, then the times when the market's down, that's actually working to my advantage when it comes to buying my investments. Now, if that simple explanation didn't do it for you and you're not sold, don't worry. We're gonna get into all of that in a lot more detail.
Right now is an interesting time because everything is crashing. And I mean like seriously, everything.
From where I'm sitting in Silicon Valley, this is the worst environment that I've seen since the dot-com crash, even worse than the Great Recession of 2008, 2009.
Growing quite concerned, I think it's fair to say, about what's happening in the crypto market.
The top stock market indexes like the Dow, the Nasdaq, and the S&P 500 are down anywhere from 10 to 30% year to date, and Bitcoin's even further down. At first, this seems weird because crypto is supposed to be completely uncorrelated and unlinked to the stock market, and technically it is, but a lot of the same people who own stocks also own crypto. So the same investor mindset and investor confidence that's causing a lot of people to not believe in stocks right now is also impacting crypto as well. Now, the markets have kept going lower and lower all year long so far, and basically every time an index goes up a little bit, it also goes back down even lower. And for all of you who own investments in the stock market, so stocks, index funds, ETFs, all of that, right now is going to be a true test of your risk tolerance and your investment willpower, because right now is going to be a time where you either make a lot of money by sticking it out or you lose a lot by selling. The one thing that everyone is saying right now is basically, see, the markets don't only go up, even though tons of people might have thought that if they had started investing back in 2020, like thousands and thousands of people did. There was a survey that Charles Schwab did over a year ago that found that at least 15% of US retail investors started investing in 2020. And for the first year and a half or so of them being in the markets went up. And I mean, they went up a lot. Now it's a different story, but the other side that's super important to mention too is that stocks don't only go down either.
This is one of our favorite charts to show what happens every time there's a decline in the market. Every time that the market's crashed in the past, from after both world wars to during the last decade, every single time there's been a significant drop, the market's recovered and become higher and more valuable within a relatively short period of time. Let's also look at this historical chart of the S&P 500. Again, you can see that the market overall is always going up, even after these big crashes. But let's zoom in a little here and look at the specifics. Let's say that this is you. You started investing in just after the 2020 crash that also lined up at the beginning of the pandemic. And in a year and a half after that time started, the market grew a lot. Let's say that you just invested in funds that tracked the S&P 500. That means that you saw your investments grow over 100% in about 20 months, which means that this year, when you're seeing that the market's dropped over 15% year to date, that feels crazy and like you're losing everything. Now let's look at a different time period. Let's say that you actually started investing in March 2003 instead, right at the lowest point. For the first 4.5 years, things would be looking pretty good until the 2008 recession happened. Now, in that time, if you panicked and you sold all your investments, or if you just stopped investing and stopped buying in when the prices were low, then you would have missed out on some of the biggest gains that were ever seen that came right afterwards. Just look at the massive growth that happened between 2010 and 2021. If you look at this chart, you can see that there was a ton of green during this time period. And even if the red's coming right now, which we're obviously starting to see, in the history of this market index, every time there's been a dip and the red was coming, the green came back afterwards and even higher than it was before. Overall, this is exactly why when we talk about passively investing in the market for the long term, we mention average annual returns. And that's because some years you're going to see super high returns, some years you're actually going to see losses in your portfolio, but overall, during a period of decades, you should see an average return of about 10.5% when it comes to the S&P 500.
So now that we know that the market goes back up after it goes down, now we need to touch on who actually owns these stocks and what these times of market downturns actually do for them. We talked in the past about the fact that the wealthiest 10% of Americans own about 89% of all US stocks. So just let that sink in. 10% of people, 90% of stocks, which means yes, 10% of stocks, for 90% of people. Specifically, the bottom 50% of people own about 0% of the stocks, and the bottom 50 to 80%, they only own 3% of the stocks. This is a huge difference. So when people with a lot of money see a recession, guess what they do? They keep buying. They take advantage of the recession, and this is how the rich get richer during this time. The only people who benefit from prices going down, being cheaper, and then ultimately going back up are the people who actually own stocks, and most importantly, the people who kept buying. Now, the kept buying piece is important too. The people with a lot of money, so the multimillionaires and billionaires, they most likely kept buying without thinking too much about it. Now, the other people who are buying stocks, so people like us who aren't multimillionaires and billionaires, we're stock owners, but we're either too scared to buy when the market's low, or we can't afford it anymore because we're bogged down by rising prices and the potential fear of losing our jobs. This is a chart showing that during the short pandemic recession we had in 2020, employment rates fell by 19% for low-wage workers, 4% for middle wage workers, and they actually grew by 1.2% for high wage workers. Obviously, high wage workers can keep buying stocks that they probably already have, but low and middle wage workers, they're worrying about their day-to-day expenses and their employment instead. So even if a drop in the stock market would be a great time to start investing and owning stocks, it's just not happening. So this is how the wealth inequality gap grows. But if you're a part of that group of people who can still afford to keep buying stocks even during a crash, where you're only debating on selling or not buying because of fear, then you're doing yourself a solid disservice by not buying.
So what do we actually mean when we say to keep investing and buying into the stock market during a crash? One way you can do this, especially if you're a passive long-term investor, is by dollar cost averaging. Basically, dollar cost averaging is a way to reduce your risk when investing. So instead of trying to time the market and figure out when the lowest price to buy is gonna be every month, because you're never gonna know exactly when that is, instead of doing that, you're gonna put the same amount of money into an investment, like a stock or ETF, every month at the same time, for example. This is actually what both Dennis and I do. So in my case, I put $1,000 into my robo-advisor portfolio of ETFs every month on the same day. Basically, the premise here is that even if you buy in when the price is higher one month, so for example, let's say that you have an ETF, you have $1,000 put into it every month. One month when the price is at $100, you can get 10 shares, but then the next month if the price shot up to 150, you can get less shares than that. Even if that happens to you and you buy higher, there's also gonna be months where you buy at a lower price. And ideally that averages out to a cost that's gonna be less than if you kept trying to time the market instead. Overall, this strategy is about buying an increasing number of shares at lower prices overall, which means a bigger return for you when those values eventually rise. So basically when a stock market crash happens, you can keep using this exact strategy because you know that there's these lower prices for an extended period of time. So no matter what specific day you buy at, overall you're buying at a low price. And when the market rises again, as it always has historically, that's when you see that big payoff. Something else that's really important to mention on this point too is that the best days in the stock market tend to follow the worst days. So yes, you heard that right. The best days in the stock market follow the worst days in the market. In fact, the best 10 days in the stock market over the last 2 decades, they were all during the biggest parts of the crashes, like in the recession of 2008 and in March 2020. So if you weren't investing during this time, or if you stopped investing, not only did you miss out on some of the lowest prices that you could buy in at, like we've been talking about throughout this whole video, but on top of that, you also missed out on some of the best days of returns as well. Now, I want to really emphasize that point with an example so you can really visualize it. According to a study done by JP Morgan, if you had put $10,000 into the S&P 500 back in 1999, then you'd have $30,000 by 2018. But if you missed the market's 10 best days during that time period, you'd have only $14,000 instead. That's a crazy difference, and it's less than half of your money for just missing 10 days over 2 decades. Now back to dollar cost averaging before we end this off. It's really important to mention that this strategy is most proven to work with investments that are likely to rise in price. The strategy assumes that the price will rise eventually, which means that it's most useful to use this strategy of dollar cost averaging with either blue chip stocks or passive funds that track the market, as opposed to more speculative stocks.
So the markets are down, but if you have income coming in and you're investing for the long term, then really all you need is that mindset shift to make sure that you don't lose any money. And honestly, it's a really great time to learn too. All right guys, that's a wrap on this video. We appreciate you guys watching, and if you liked the video, make sure you actually show us some love down below with a like. It really does help out the channel a ton. And if you haven't already subscribed, subscribe right there in the corner. I know some of you haven't, so make sure you do right there in the corner. And yeah, if you guys want to check out some of our other videos on why the market is down right now and some of our other thoughts, make sure you check out those videos next door. We will be back. You know the vibes. Let's go.